Good morning and welcome back to the BL6 webinar series. Today I am going to discuss with you another very important topic, which is marginal and absorption costing. I think this is very important to manage some other chapters also, such as variance analysis and some other chapters. This topic has direct impact on other chapters also. That is why I thought of discussing this topic little in advance before we move into other topics during this webinar series, right? Fine. That is the background for selecting this topic today. Similar to other webinar series, this also will consist of theory plus MCQ questions. When I say theory plus MCQ questions, majority will focus on MCQ questions. Why? Because as I told you in the previous sessions also, you do not have much more experience in doing this subject with MCQ questions. Therefore, it is very important for us to practice those questions to see how examiner can structure this topic into MCQ questions, right? Fine. Marginal and absorption costing. What is the difference between these two? What is the importance of this topic, right? What is the impact of marginal costing and absorption costing to your profit calculation, and how this topic deals with accounting standards, right? What is the recommended method when you calculate profit? All these things we need to discuss. I will touch here and there important theoretical aspects. Since you have study pack, you can go through little in detail. In this webinar series, we might not be able to cover end-to-end theory, right? But I am trying to capture important areas. However, through MCQ questions, the entire topic will be captured, right? That is how I have structured this session. Marginal costing and absorption costing. In marginal costing, what is the important thing you need to understand? We consider fixed cost, fixed production cost. When I say fixed cost, fixed production cost, which means fixed production cost incurred to manufacture your output, right? Fixed production cost incurred to manufacture your output. When I say fixed, you know the characteristic of fixed cost. What are they? When activity level change, fixed cost remains unchanged. In marginal costing, we consider fixed production cost as periodic cost, period cost, which means when activity level change, fixed cost will not absorb to each and every activity. We consider fixed cost as periodic cost, which means you will charge to that relevant period, not to the relevant unit of output. But absorption costing, right, the name itself, it says you have to absorb. What you need to absorb? Fixed cost to what? Unit of output, which means to the production unit. That is the difference. In short, in marginal costing, fixed cost, fixed production cost we consider as period cost, whereas in absorption costing, we absorb fixed cost, fixed production cost to unit of output. So, in this statement, what you need to understand, the difference between marginal costing and absorption costing is what? The treatment for fixed production cost. That is the first thing you need to understand. Marginal costing differentiate from absorption costing because of what? The treatment for fixed production costing. In marginal costing, it is periodic cost. In absorption costing, you absorb that into the unit of output. This has impact to your profit. Different companies, they follow marginal costings, and some companies they follow absorption costing. In future we will understand how do you select marginal costing and absorption costing in your organization. Otherwise, no point of learning these things. There is a method called marginal costing and another method called absorption costing. What is important for us? So, based on the nature of the organization, company, especially if you are in manufacturing organization, what method you should select? We will answer that question also, right? Fine, look at this slide. In marginal costing, fixed production costs are treated as period cost and are written off as they incurred. When you incurred fixed production cost to a particular period, right? Let us say 1 million fixed production cost for the year ended 31st March 2020. So, then you charge that 1 million to that period instead of going through what? Instead of absorbing that to unit of output. But in absorption costing, fixed production cost are absorbed into cost of unit. In absorption costing, you absorb the cost of unit and are carried forward in inventory to be charged against the sales for next period, right? Look at this example, right? Now, let us say you produce 1000 units, 10,000 units during the period, 10,000 units you produce during the period. In marginal costing, right, let us say during this period fixed production cost overhead 1 million, right, 1 million. In marginal costing, this 1 million charged to P&L as period cost. This is simple treatment in marginal costing. But when it's come to absorption costing, right, we have to absorb into unit, right, we have to absorb into unit. Now, when you absorb into unit, right, this 1 million divided by 10,000, you will identify fixed, let us say 1 million is the total cost divided by 10,000, right, 10,000, which means 100. So, fixed production overhead, right, fixed production overhead per unit how much? 100. You will absorb this 100 into what? Unit. So, when you absorb, definitely at the end of the period, you may have opening at the beginning opening inventory, opening balance and the closing balance, opening balance and the closing balance. When you absorb this 100 into unit of output, in closing balance, let us say you have some amount of inventory, let us say 2000 units, 2000 units you have. In this 2000 units, you have 100 fixed production overhead cost. Why? Because total fixed production overhead cost 1 million, right? You have produced 10,000 per unit, fixed production overhead cost 100. So, then you have 200,000 fixed production overhead absorbed to closing inventory. This is absorbed. The difference is 1 million you will charge to P&L according to marginal costing, but according to absorption costing, since you have absorbed into unit of output, right, this 200,000 you will carry it forward to where? Next financial year. Because closing inventory, right, you will, the value of closing inventory you will deduct from cost of sale according to your cost of sale calculation, and this will reflect in your balance sheet, and this will be solved during next financial year. That is why when you calculate cost of sales, you add opening inventory plus purchase plus minus closing inventory. So, this will be carried forward. That is what he said. In absorption costing, fixed production cost absorbed into the cost of unit and carried forward in inventory. This is the clause in inventory, right? Right, closing inventory. You will carry it forward, fixed production overhead absorbed to inventory through what? Closing inventory next period. Inventory value used in absorption costing are therefore greater than calculating use in marginal costing. Because of that, since you absorbed fixed production overhead cost into inventory, inventory value will be higher, greater in absorption costing compared to marginal costing. Fair? No? In marginal costing, you will not absorb this 1 million into this units. But in absorption costing, you absorb fixed production overhead cost to units. Therefore, inventory value will be higher according to what? Absorption costing compared to marginal costing. Simple to understand. Keep this in your mind. So, what you need to understand first, marginal costing and the difference between marginal costing and absorption costing is what? The treatment for fixed production overhead cost, right, and that has impact on inventory valuation as well. Second one, this can be tested in your exam as MCQ questions. What is the difference between marginal costing and absorption costing? Examiner can give you 4 answers and you have to select the correct answer. Look at this slide. This has clearly explained you the difference. In marginal costing, opening and closing inventories are valued at marginal production cost, which means variable cost, right. But in absorption costing, opening and closing inventories are valued at full production costing. Full production cost means including fixed production overhead cost. Marginal production cost means excluding fixed production overhead, which has only variable production overhead, right. In marginal costing, fixed production cost are period cost. You will not absorb to 1 unit, right. But in fixed absorption costing, fixed production cost are absorbed into cost. Fixed production overhead, fixed production cost absorbed into unit cost. In what? Absorption costing. In marginal costing, cost of sales does not include share of fixed overhead. Cost of sale wala fixed production එකේ overhead cost එකේ share එකක් නැත. In absorption costing, cost of sale does include a share of fixed overhead. Those are the 3 key differences when you compare marginal costing versus absorption costing. Look at this note. To share fixed overhead included in cost of sales are from the previous period, which means the opening inventory value, right? Sum of the fixed production overhead from the current period will be excluded by being carried forward into closing inventory value, which means in my example, the total fixed production overhead cost 1 million, are part of 1 million, which means 200,000 you will not charge to this financial year, but you will carry it forward to next financial year through what? Closing inventory. So, for the given period, the fixed production overhead cost will be 0.8 million in my example, because 1 million less 200,000. Why? Because 200,000 you will carry it forward to next period through what? Inventory, because in inventory you have absorbed 200,000 fixed production overhead costing, right? Fine. That is what you need to understand when you compare marginal costing and absorption costing. This is a summary. In marginal costing versus absorption costing. In marginal costing, these are the factors you consider. What are they? We consider variable cost and fixed cost also we consider, and we calculate contribution. What is the definition of contribution? Sales minus variable cost, right? That is contribution. Thereafter you deduct fixed cost. All these three elements we will consider in marginal costing, but in absorption costing not necessary to have this classification. No need to calculate variable cost, no need to calculate contribution. All cost you will consider in absorption costing, and we call it as full production cost, right? Not necessary to differentiate variable cost from fixed cost. Here in absorption costing we consider both as what? Full cost, right? Variable cost and fixed cost you consider as what? Full cost. No need to have classification like variable cost and fixed cost, right? Fine. That classification is required when it's come to marginal costing. Important to understand. Look at this example, right? Suppose that a company makes and sells 100 units of product each week. Each week you produce 100 units. Simple question to understand the concept. The prime cost, which means the variable cost per unit, is rupees 600 and the unit sales price is rupees 1000. Production overhead cost rupees 20,000 per week and administration, selling and distribution overhead cost rupees 15,000 per week. Calculate weekly profit. So, examiner's requirement is to calculate weekly profit. Read and try till I erase this board. Right. Sales how much? Sales. Unit price, they sells 100 units, per unit selling price 1000. They produce 100 units, per unit selling price 1000, right? The total sales value then 100,000. Total sales value 100,000. Then prime cost, which is the variable cost, prime cost. They produce 100, they sells 100 units and prime cost per unit 600, which means 60,000. 60,000. Thereafter they have given production overhead cost. Production overhead cost 20,000 per week, right? Yeah, production overhead cost 20,000. 20,000, right? And admin, sales, distribution overhead cost 15,000 per week. Admin, selling and distribution cost 15,000 per week. 60,000 plus 20,000, 80,000, 15,000, 95,000. The profit how much? 5,000. This is the profit for the period, which means for the week, per week, right? Now the same thing we can calculate, right, in a different way, right? How can we do it, right? Per unit, let's say prime cost you have 600 per unit, prime cost 600 per unit, and production overhead cost, production overhead per unit cost they have not given, you have to calculate it, 20,000 divided by 100, 200,000, right? This is the full cost, full production cost, because variable cost plus production overhead cost, which is called full cost, 800. This is the full cost. We use full cost in where? Absorption costing. We don't want this classification in absorption costing, we want only full cost where in absorption costing. But if you have marginal costing system, it's required this classification. Let's say now you have 800 full cost. By using full cost, how do you calculate profit? Sales, same 100,000. Sales you have 100,000. Then full cost minus factory cost. How much? 800 is the full cost, 100, 80,000. Right? Then you have sales minus factory cost is what? Gross profit, cost of sale. $20,000. Thereafter you have admin, selling and distribution cost, which is not a part of full cost, right? Admin, sales, selling and distribution, 15,000. Then profit how much? 5,000. What you need to understand, the way you calculate full cost. In both ways the profit can be same, but this is how you figure out profit in absorption costing, right? This is the way you consider, this is the way you figure out the profit according to absorption costing, right? Now, what is the accounting standard guideline? That is also very important to understand, because marginal costing and absorption costing classification, and this is useful in management accounting, which means for management to take their own decisions. How management accounting links to accounting, financial accounting. So you have to prepare financial statement according to what? Applicable financial reporting framework, which means LKS and SLFRS. For inventory, you have an accounting standard which is LKS 2. In International Accounting Standard terms, it is IAS 2. What IAS 2 is telling you? Look at this slide. So, then you will understand clearly the standard guideline on this. Absorption costing is recommended in financial accounting by IAS 2 inventories. Absorption costing is recommended. Where? In IAS 2. How? Which deal with financial accounting system. Management accounting වල තමයි අපි කතා කරන්නේ මොකද්ද? Marginal and absorption costing ගැන. But absorption costing එක recommend කරන financial accounting system එකේ LKS 2 වල තමයි ඒක explain කරලා තියෙන්නේ. Read this. The cost accountant is free to value inventory by whatever method seems best. The management accountant can value inventories by using absorption costing or marginal costing, whatever is the best, seems best. But where companies integrate their financial accounting and cost accounting system into single system of accounting record, the valuation of closing inventory will be determined by IAS 2. What does that mean? Most of the companies, they don't have two different systems for management accounting, which means the cost accounting and financial accounting. If both cost accounting system and financial accounting system integrate into one system, IAS 2 has given you to follow below guidelines. IAS 2 states that cost of all inventories, inventory cost should comprise those costs which have been incurred, cost have been incurred in normal course of business. Samanya business ekaka edinada business තමයි අපි කියන්නේ normal course of business එකේ. Very important, bringing the inventories to their present location and condition. All cost you incurred to bring in the inventories to their present location and condition. Whatever the cost you incurred to bring inventory to the present location and the condition, you have to consider those costs as a part of what? Inventory cost. So, then considering fixed production overhead cost or absorbing fixed production overhead cost into inventories is not wrong according to what? IAS 2. IAS 2 telling, accounting standard says what? Cost of inventory should be the cost incurred to bring the inventories to present location and the condition. So, then to bring inventories to present condition and the present location, you have to incur not only the prime cost, but fixed production cost as well, right. These costs incurred will all related to production overhead, even though those overhead may accrue on a time basis. In other words, financial accounting closing inventory should be valued at full factory cost. Important, highlight, make some notes. Closing inventory should be valued at full factory cost, not only at their prime cost. And it may therefore be convenient and appropriate to value inventories by the same method in cost accounting system also. In your organization, if you follow both, if you have cost accounting system and financial accounting system in one system, which means integrated, standard says cost of inventory should be cost incurred to bring the inventories to present condition and the present location. Therefore, you have to include fixed production overhead cost also, which means full factory cost. Therefore, you have to value inventory using full factory cost. Therefore, in management accounting and financial accounting you can follow the same method, right. Absorption costing is recommended through what? Accounting standard, which is IAS 2 in Sri Lanka, LKS 2. Important, can be tested, right. Now, when it's come to marginal costing, how do you value inventory? Marginal costing is the variable cost of one unit of a product or service. Marginal cost means variable cost per unit. In marginal costing is an alternative method of costing to absorption costing. Marginal costing is alternative methods of costing to what? Absorption costing. In marginal costing, only variable cost are charged as cost of sales. Very important. Cost of sales wala tiyenne only variable cost. But in absorption costing, you have both variable and fixed cost, which means full factory cost. Why? Because in inventory, you have absorbed fixed production overhead cost into inventories. Therefore, it has full factory cost. Closing inventories of work in progress or finished goods are valued at the marginal variable production cost, right. So, in marginal costing, inventories you valued at marginal production cost. Fixed cost treated as what? Periodic cost, right. Period cost, you will charge to the financial period and charge it to charge in full to profit and loss account of the accounting period in which they incurred, right. So, whatever fixed production overhead cost you incurred during that period, you will charge to P&L irrespective of absorbing that into unit of output, right. That is marginal costing. Marginal production cost per unit, how do you calculate? In marginal costing, you have to calculate contribution. What do you mean by contribution? Is an important measure in marginal costing, and it is calculated as the difference between sales and the marginal or variable cost of sales, which means contribution equals what? For what? Sales minus marginal cost, which means the variable cost. So, this is very important. So, these are the elements of marginal costing: direct material, which is variable cost; direct labor also, which is a variable cost; and variable production overhead cost. These three will deduct from sales to figure out what? Contribution in marginal costing. Read this question and try. Examiner's requirement is what? Calculate contribution and profit for the period using marginal costing principles. If sales as follows, if sales are at these levels, you have to calculate profit. Try it. There are three activity levels: 10,000, 10,000, 15,000, and 20,000. 20,000. So, under these three levels, you need to calculate what? Profit by using marginal cost principles, right. What are the information they have given? Rain LLC makes a product, right, the splash, which has variable production cost rupees 600 per unit and the selling price 1000 per unit at the beginning of September 2020. There were no opening inventories and production during the month was 20,000 units. Fixed cost for the month were 4.5 million, production, administration and distribution cost. There were no variable marketing cost. You need to calculate profit by using those information according to marginal costing. What are the sales? Sales. You will is the sales, these are sales levels, right? Selling price per unit 1000, sales at 1000. 1000 into 10,000. I will work out in this in thousands, right? So all these numbers are in thousands. 10,000. Sales 10,000. Under 15,000 level 15,000. Here 20,000. In thousands, right? Thousands. Then they said no opening inventory. Opening balance inventory 0. No balance, right? And they have given some information. They have produced how much? During the month they have produced 20,000 units, right? 20,000 units they have produced, which means production, variable production cost. Cost how much? 20,000 they have produced, per unit 600, which means 12,000. So here also 12,000, here also 12,000, because production will not change, no? Sales under each activity level, production cost same, because 20,000 you have produced. Then closing inventory, closing balance inventory, right? Closing balance inventory, because you will not consider fixed production cost in this case under marginal costing. This is marginal costing, no? Marginal costing. In marginal costing, fixed production cost we consider as period cost. Therefore, we will not consider for this contribution calculation what? Fixed cost, right? Closing inventory, you have closing inventory also you value by using what? Marginal costing. In absorption costing, full cost you will consider, which means fixed production overhead cost also you absorb to unit of output, but here you will not do it. Closing inventory, first scenario, production 10,000, sales 10,000, which means closing inventory 10,000 per unit, prime cost 600, closing inventory 6,000, correct, no? Here production 20,000, sales 15,000, which means closing inventory 5,000, 5,000 into 600, 3,000, 3,000, right? Here production 20,000, entire production has sold, no closing balance, no closing balance. Take the net, here 6,000 here 9,000, here 12,000. Then you can calculate contribution, because contribution is the difference between sales and the variable cost. This is the sales, this is the variable cost, 4,000, right. 15,000 minus 9,000, 6,000. 20,000 minus 12,000, 8,000. This is how you calculate what? Contribution. From contribution, in marginal costing, we consider fixed production cost as periodic cost. How much the fixed production cost? Fixed cost including production cost, administration cost, sales and distribution all together, 4.5 million fixed cost, 4.5 million, 4,500. 4,500. What is the profit? Here you have loss of 500, here you have 1,500 profit, here you have 8,000, 3,500 profit, right? 3,500 profit. Right, fine. Now look at per unit profit, profit per unit, how much? There is a loss here, 10,000 divided by 500, 20 loss, 20, sorry. Yeah. So, you have 500 loss, 10,000 units, right? 500, 50, sorry, 50. There you have 1,500 divided by 15, 100 profit. Profit here 3,500 per unit divided by 20, 3,500 divided by 20, 175. 175. Calculate the contribution per unit also. Here contribution 4,000 divided by 10, 40, right? 400, no? 4,000 divided by 10, 400. 6,000 divided by 15,000 units divided by 15,000, 400. 8,000 divided by 20, 400. What is the observation? When activity level increase, right? When sales increased, you are making profit according to the profit per unit increase according to marginal costing. But when you make less sales, 10,000 compared to production, which means 50% of the production you have sold, you are making loss. If you sell entire production, you will have higher profit per unit. But according to marginal costing, since we do not consider fixed production cost into unit of output, per unit contribution will be always same according to what? Marginal costing. But in fixed production costing that is not the case, right. I have summarized the entire story. Look at this. The conclusion from this calculation is what? Fixed, the profit per unit varies at different levels of sales, because what? Average fixed production overhead cost per unit charge with the volume of output and sales. That is the first thing. The average fixed production overhead cost per unit charge with the volume of output and the sales. The contribution per unit is constant. Why? At each level, all levels of output, the total contribution, which is the contribution per unit multiplied by number of units sold, increased the direct proportion to the volume of sales. Since the contribution per unit does not change, the most effective way of calculating expected profit at any level of output and sales would be as follows. How? The first calculate total contribution. First you calculate total contribution, then deduct fixed cost as periodic charge in order to find the profit. In accordance with what? Marginal costing, right. I have made slide change to the previous question. Look at these numbers. In our example, the expected profit from sales, let us say 17,000. So then contribution 17, because contribution is constant, no, it will not remains, it will not change, it will remains unchanged at each activity level, whether it is 15,000, 10,000, 20,000, contribution per unit 400, contribution per unit 400 constant. So therefore, under 17,000 activity level, the total contribution would be 17,000 into 400, 17,000 into 400, which means 6.8 million in 1000, 6,800. Less fixed cost will be considered as periodic cost, right, you will not absorb into unit. Total fixed cost including sales and distribution and production 4,500, the profit will be 2,300. If total contribution, this is a learning outcome. If total contribution exceeds fixed cost, look at this, total contribution under activity level 10,000, total contribution exceeds fixed cost 4,500. Fixed cost එක වැඩි නම් contribution එකට වඩා you are making losses, right. If total contribution exceeds fixed cost, a profit is made. Contribution එක වැඩි වෙන්න ඕනේ fixed cost එකට වඩා. Here වැඩි. If total contribution exactly equal to fixed cost, no profit, no loss, break even. If contribution 4,000 and let us say fixed cost also 4,000, no profit, no loss, which means you are break even. If total contribution less than fixed cost, then you are making a loss. Under activity level 10,000 you are making a loss because of that. Why? Contribution is less than fixed cost, therefore you are making losses, right. Fine. So that is the learning outcome you have to take from this. Very important topic. Examiner can set up nice questions from this area, right. Nice questions examiner can test. Profit reconciliation. So how do you reconcile profit when you calculate profit using absorption costing and by using marginal costing? Profit will be different. Why? In absorption costing you will absorb fixed cost into inventories, therefore closing inventory you will charge, you will carry forward to next financial year, therefore part of fixed cost you will charge to you will carry it forward to next financial year. How do we reconcile this? That is very important, right? Before we move into calculations, look at this slide. Reported profit figure, very, very important. Make some notes, right? If you are forgotten, you have to have some logic to keep this in your mind. Otherwise, you will be confused in the exam, right? Reported profit figure used in marginal costing or absorption costing will differ if there is any change in level of inventories in the period. If inventories are changed, which means level of inventories means if there is a difference between opening inventory and the closing inventory, if there is a difference, definitely profit you calculate according to marginal costing will be changed to the profit you calculate by using absorption costing. Why? In absorption costing you absorb fixed cost to unit cost, and therefore closing the fixed cost portion of closing inventories you will carry it forward to next financial year. That is the first thing we have discussed today at the beginning of the session. If you can go to the first 2-3 minutes, you will understand this. Therefore, this difference makes if there is a change in activity level, which means if there is a difference between opening inventory and closing inventory. If production is equal to sales, if entire production if you sold, there will be no difference in calculated profit using the cost using costing methods, which means if the production entirely if you sold, there is no difference between opening and closing inventories. No? If the production is not sold, or if you sell more than the production, opening inventory difference to closing inventories. If you produce let us say 1000 units and if you sold 1000 units, there is no difference between opening and closing inventory, right? Then there is no impact to the profit. But if there is a difference between opening and closing inventory, definitely profit reported according to marginal costing will be different from absorption costing. The difference in profit reported under two costing system is due to different inventory valuation methods used, right? Different valuation methods. Why? In absorption costing, full cost will be considered. In marginal costing, to value inventories, cost of sales, to value inventories, right? You will use only the prime cost. Marginal costing එකේ closing inventory එකේ තියෙන prime cost එක විතරයි. But absorption costing එකේ closing inventory එක ඇතුලේ fixed production overhead cost also absorbed, right? Understand. If inventory level increase between beginning and the end of the period, absorption costing will be reported higher profit. Look at this. I will summarize. මේක තමයි තේරුම් ගන්න ඕනේ logic එක. This is very important. If inventory level increase, right? Let's say opening balance, closing balance you have inventory, yeah? Right? If closing balance inventory level increase between beginning and the end of the period, if this is increase, closing balance increase, marginal costing and absorption costing, what will be the profit, impact to the profit? Absorption costing will report higher profit. Absorption costing එකේ profit වැඩි. This you have to keep in your mind. This is the logic. This will help you to manage most of the exam questions. When opening balance, closing balance increase, closing inventory balance increase, right? This is inventory. Inventory. If closing balance increased, when you compare profit calculated by using marginal costing and absorption costing, in absorption the profit figure reported in absorption costing is higher. If inventory level increase between beginning and the end of the reporting period, absorption costing will report higher profit. Absorption costing will report higher profit. This is because of what? This is because some of the fixed production overhead cost incurred during the period carried forward in closing inventory to be set against sales revenue in the following period. Why? Because according to absorption costing, closing inventory has fixed production overhead cost also. Fixed production overhead. Also you have absorbed to closing inventory. Since you have absorbed fixed production overhead cost to closing inventory balance is high compared to marginal costing that we have discussed. Because you are carrying forward this cost to next financial year, you will deduct more amount, high amount from cost of sales. As a result, profit will be increased. Understand? Right? Because of that, according to absorption costing, profit will be increased. Clear? Another example I will take. Now let us say sales, right? 10,000. Inventory, opening balance inventory. Simple example. Let us say 100,000. Purchase 5,000. Closing balance, let us say 2,000. The cost of sales how much? 1,000, 6,000, 6,000, 4,000, right? 4,000. The gross profit 6,000. Here, let us say opening balance remains unchanged, 1,000. Production 5,000. Right, 5,000. Let us say closing balance increase to 3,000. Now, cost of sales how much? 1,000, 6,000 minus 3,000, 3,000. Profit will be 7,000. Now, understand. When closing balance increased from 2,000 to 3,000, profit also will be increased. Why? Because you have absorbed fixed production cost into this according to absorption costing. But in marginal costing, fixed production cost part is not there in the inventory balance. Therefore, there is no difference. That is why under each and every activity level, contribution is same. Right? Fine. This is the reason. Understand, right? Keep this concept in your mind. So then it is easy for you to manage any exam question, right? Fine, done. Other way, if inventory level decrease, absorption costing, if this is decreasing in absorption costing, will report lower profit as well as fixed overhead incurred, fixed production overhead is released and is also incurred in the cost of sales, right? Fine, very important slide, powerful slide, right? Okay, look at this question. When opening inventories give me a second, right? When opening inventories were 8,500 liters and closing inventories 6,750 liters, a firm had profit 62,100 using marginal costing, right? Calculate the profit using absorption costing assuming fixed production overhead rate 3,000 per liter. right? Fine. Right? Here, look at this. What are the information they have given? Opening inventory they have given, closing inventory they have given, right? Difference in inventory, you have to calculate 8,500 minus 6,750. How much? $8,500 minus 6,750. $1,750 is the difference. What has happened? Opening inventory 8,000, closing inventory 6,000, which means closing inventory has come down. Which means absorption profit should be reported lower profit than marginal costing. Other way around, no? Right. The profit is different because of what? Treatment for fixed cost. Difference in profit. $1,750 into this profit difference makes because of what? Only fixed production, treatment for fixed production overhead. In marginal costing only prime cost, in absorption costing full cost. The difference is what? Marginal costing and full cost, fixed production cost, right? In marginal costing fixed production cost is not there. Here they have given, assuming that fixed production overhead absorption rate per unit, they have absorbed 3 units, fixed production absorption per unit 3,000. Sorry, 3 per unit. So, profit is difference only because of fixed production overhead cost. How many units they have? The difference is, the activity level difference is how much? 1,750. The profit also will differ from that figure. Understand? Very simple. 5,250. Understand this. Very powerful message. Marginal costing and absorption costing අතර difference එක තියෙන්නේ මොනවා හින්දා විතරමද? Treatment for fixed production overhead cost. Opening balance එකයි closing balance එකයි සමානයි නම් there is no difference, there is no profit difference between marginal costing profit and absorption costing profit. But marginal costing profit එකයි absorption costing profit එක අතර difference එකක් එන්නේ when activity level change, which means if there is a difference between opening inventory and closing inventory. Here opening inventory and closing inventory difference. How much? Activity level change by 1,750. May 1,750 වලට per unit overhead absorption කීයද 3. එහෙනම් profit එක difference වෙන්නේ මෙන්න මේ amount එකෙන් 5,250. Why? This is the fixed cost for level of activity change, right? Then අපෙන් අහනවා if profit has reported 6,200 marginal profit according to marginal costing 6,262,100 num. What is the profit according to absorption costing? Profit difference is this, difference in profit. Difference again මෙන්න මේකයි සූත්‍රය. මතක තියාගන්න. Difference in activity level into fixed production absorption per unit fixed production absorption rate. Right? ඒක logical නේ. මොකද difference එක එන්නේ දෙක අතර fixed production එකේ විතරමයි. එන activity level change වෙනවා. මේ level change වෙන activity level එකට කොච්චර fixed production එකක් තියෙනවද? Right. මොකද activity level එකට තියෙන අඩු වෙලා තියෙන්නේ. අඩු වෙලා නම් absorption costing should report lower profit, which means you have to reduce this by 5,250. Fair. Right? 62,100 minus 5,250. 56,850. This is the profit. Correct, no? If activity level increase, absorption costing, the profit and absorption costing should have been increased. Here activity level reduced, therefore absorption costing should report a lower profit compared to marginal costing. Right? The logic I have explained somewhere here. Right? This difference is coming from activity level change. Activity level change how much? 1750 per unit fixed production cost 3. This is the difference, profit difference between absorption costing and marginal costing. Treatment for fixed production cost. Understand? Fine. That's all. Now we are going to discuss set of MCQ questions. This is the interesting part. Right? Now we can see how examiner can set up nice exam questions, MCQ questions. Important. We will see. Keep this logic in your mind. This will help throughout the session. Right? Okay. Read question number 1 and try it. Since we have completed theory, you should be able to answer that question. The following data is available for period 9, opening inventory 10,000, closing inventory 8,000, absorption cost in profit 280,000. What would be the profit for the period 9 using marginal costing? Right? First you have to calculate difference in profit. Difference in profit. This is the first thing you need to calculate. Difference in profit equation is what? Formula is what? Change in activity level, inventory level. Inventory level, right, which means opening balance minus closing balance. The difference is that. Change in inventory level into fixed production absorption rate, fixed overhead absorption rate per unit, fixed overhead absorption rate per unit. This is the difference in profit. Profit difference කියන්නේ profit under marginal costing and profit under absorption. Difference is this, because of this activity level change, opening to closing activity level change into fixed production absorption rate per unit. Eka unit එකකට තියෙන fixed production absorption rate එක. Right? Fine. Now apply numbers. Opening balance 10,000. 10,000 minus, take the difference, closing balance 8,000. Inventory level has reduced, fixed production, fixed cost absorbed how much? 280,000. Fixed cost, fixed absorption, absorption cost in profit how much? Absorption cost in profit, absorption cost in 280,000. 280,000. Now we need absorption rate, but they have not given that information. Closing balance or opening balance inventory they have given, absorption profit they have given. Because of that, we might not be able to calculate profit, difference in profit. In the absence of difference in profit, we might not be able to figure out the profit figure according to marginal costing. Right? There are 4 answers. 278,000, 280,000, 282,000. impossible to calculate without more information. That is the correct answer. We can't do it. We can't calculate. Why? Because there is no way to figure out fixed production absorption rate. We know that the profit used in marginal costing would be higher than absorption costing profit, because inventories are decreasing, right? Inventories are decreasing. Therefore, however, we cannot calculate the value of difference in profit without fixed overhead absorption rate per unit. Because of that, answer is what? D, right? I also figure out now when I look at the information. Those are the questions that can be tested. Question number 2. Overhead absorption rate for the product T is 4 per machine hour. 4 per machine hour, right? Each unit of T required 3 machine hours. එක machine hourකට cost එක කීයද 4 per unit, 3 machine hours required. Inventories of product T last period were opening inventory they have given, closing inventory they have given. Compared with the marginal costing profit for period, absorption costing profit of product T will be which of the following, right? Now calculate the change in profit. First of all, 2,400, apply numbers to this formula. Change in activity level how much? 2,700 minus, better to take always one way, right? Opening minus closing. 2,400, 2,700 into absorption rate they have given how much? 4 hours required for per machine hour we pay for 3 machine hours required. This is absorption rate 12. What's the difference in profit? 2,700 minus 2,400 into 12, 3,600. This is the difference in profit. Since they have not given profit under marginal costing or absorption costing, we can't figure out anything, but we can say since inventory level has increased, inventory level has increased, inventory level has increased and absorption costing profit should have been increased. That's the question they are asking. Absorption costing profit should be 3,600 higher, right? The correct answer is what? B, 3,600 higher. Question number 3. In a period where opening inventories were 15,000 and closing inventories were 20,000 units, a firm had a profit of 130,000 using absorption costing. If the fixed production overhead absorption rate per unit 8 per unit, the profit used in marginal costing would be which of the following? Apply numbers. Same formula you had used, for that you can apply numbers. Change in activity level. Opening inventory 15,000, that has increased to 20,000, which means under absorption costing profit should be higher. Absorption rate they have given 8. Change in profit should be how much? 5,000 into 8, 40,000. 40,000. Change in profit should be 40,000. Now they are asking what is the profit under marginal costing? Profit, marginal costing. Absorption costing profit they have given how much? 130,000. 130,000. This should be higher when you compare with marginal costing, therefore this should be lower, which means subtract 130,000 minus 40,000, 126,000 is the profit, right? Sorry, 130,000 minus 40 means 90,000. The correct answer is what? A. The correct answer is A. Inventory level increase, absorption profit should be higher, right? Fine. Logic I explained, right? Fine. Question number 4 and 5 are based on the given information. Read those. Cost and sales price details for product Z are as follows. Cost and the selling price details for product Z are as follows. Direct material 6 per unit, direct labor 7.5 per unit, variable cost 2.5 per unit, fixed overhead absorption rate 5. Profit margin 9 and then selling price they have given 30. Budgeted production for month of for the month was 5,000 units, although the company managed to produce 5,800 units. Selling managed to produce 5,000 units and selling 5,200 units of them and incurring fixed overhead cost of 27,400. What is the marginal cost in profit for the month? They are asking marginal cost in profit for the month. When you calculate marginal cost in profit, you need to calculate first contribution. You need to first calculate contribution. What is the contribution? Selling price 30, right? Selling price minus variable cost. Variable cost how much? 6 direct labor, direct material plus 7.5 direct labor, variable cost 5. These 3. Sorry, variable overhead 2.5. minus 6 minus 7.5 minus 2.5, which is 14. Contribution per unit 14 rupees, dollars, right? Currency doesn't matter. Then contribution per month how much? $14,000 into per month you produce, you sold how much? The selling price, sale number of units sold you have to consider, right, to calculate contribution. 5,200, 72,800. Don't take production unit or whatever, because contribution is relating to sales. Sales minus variable cost. Therefore, number of units you sold you have to consider here, right? Then deduct fixed cost. Contribution you have fixed cost. Fixed cost you consider as periodic cost in marginal costing. How much? 27,400 they have incurred. $27,400. 45,400. 45,400 according profit according to marginal costing. This is the profit. These are very simple questions. 45,400 reflect in answer A. The correct answer is what then? A. 5. Question number 5 also based on what? The same information. What is the profit based on absorption costing? You have to calculate the profit based on absorption costing. Now, this is marginal costing, absorption costing. How do you calculate profit? Right? You have sales of sales. How much? Number of units you sold 5,200 into selling price 30. 5,200 into 30. How much? 156,000. 156,000. Material cost. Here you consider full cost. Deduct full cost. Material 5,200 into 6, right? 6. $31,200. Labor 5,200 into 7.5. 39,000. 39,000, right? Then you have variable overhead 5,200 into 2.5. 13,000. 13,000, right? So then total variable cost 83,200. Total variable cost. Fixed cost, deduct fixed cost. How much? Fixed cost, how do you calculate fixed cost? ₹5 absorption rate into budgeted production for the month was 5,000, right? 5,000, and you produce, sorry, although you have produced 5,800 units and you sold 5,200, absorption costing එකේදී අපි absorption rate එකට තමයි absorb කරන්නේ, right? 5,200 26,000. What is the profit? 156,000 minus 83,200 minus 26,000. 40 yeah, 48,000, 46,800. Here this is absorbed cost, absorption. If you have absorption, according to absorption costing method, you have to see whether you have absorbed over amount or less than that. How do you calculate it? Overhead absorbed. How much you have absorbed? Overhead absorbed 5 into 5,800 units you have produced, right? 5,800. How much? This is absorbed amount, 5,800 for the production, entire production. 29,000 you have absorbed, right? This much of units you have produced, and you have sold out of that 5,200. But incurred cost, overhead incurred 27,400. 1600 you have absorbed more. Understand? While you incurred 27,400, actually you have incurred 27,400, but you have absorbed to entire production, 5,800, 29,000, which means you have absorbed more 1,600. You have here you have included more amount has been deducted, no? හරිනේ absorb කරලා තියෙන ගාන වැඩි දැන් actual එකට වඩා absorb කරලා තියෙන ගාන වැඩි. එහෙනම් තව 1600 එකතු වෙන්න ඕනේ. over absorb. $1,600 plus 1,600, right? 46,800 plus 1,600, 48,400, 48,600, right? Yeah, 48,600. What is the answer? 48,600 sorry, question number 5. Yeah, 48,600 answer is there in answer. 48,400 answer is there in D. The correct answer is what? D. Correct answer is D. Now what I want to tell you, if you end up with this 48,600, 46,800, this is also there as answer. Sometimes you will select the wrong answer. You have to adjust, keep this in your mind, you have to adjust over or under absorption. How do you calculate it? This is the way of calculating over or under absorption. Over, under absorption. Right? Take the absorbed cost and take the incurred difference, you have to adjust. Since you have over absorption, that over absorption we have to add to the profit, right? 48,400. Okay, question number 6. Read it till I erase this. Question number 6. In a period, a company had opening inventory 31,000 units and closing inventory 34,000 units. Inventory has been increased. Absorption profit should have been more. Profit based on marginal costing 850,500. And absorption costing 955,500. If the budgeted total fixed cost of the company was 1.8 million, what was the budgeted level of activity? Budgeted level of activity unit. Little complex, and I would say it's a nice question, right? We'll see one by one. Increase in inventory, how much? Step by step we'll resolve. Increase in inventory. Inventory has been increased by 3,000, right? 31,000 opening balance to 34,000. Inventory activity level has been increased by 3,000, opening to closing activity level has increased by 3,000. Then profit increase, therefore profit also should have been increased, no? According to absorption costing, profit also should have been increased, absorption costing. How much? marginal costing 850,500 to 955,500. What's the difference? $500 minus 850, 500. 1,000, 100,000, sorry, 105,000. 105,000. This is the difference. Because of that, same equation, same logic you can understand, right? Fixed production cost included in inventory, right? Which means fixed production overhead absorption rate. Fixed production overhead cost per unit. How much? Absorption rate depends on what? Absorption, apply the equation, right? Here, apply this. So, in other way, look at this black color thing. Change in profit how much? 1,500. Change in inventory 3,000. Fixed production overhead absorption rate, we do not know. 1,500 divided by 3,000. Then you will have fixed overhead absorption rate. Nothing new. Same formula used to figure out fixed production overhead absorption rate. How much? 35. 35 absorption rate. Using this formula equation, I figure out this point, fixed production overhead absorption rate. Now the question is what? If the budgeted total fixed cost, right, total fixed cost they are asking අපෙන් අහන්නේ මොකද්ද? budgeted activity level එකනේ. budgeted activity level. Total budgeted fixed production overhead cost how much? 1,837,500. This is the total budgeted cost. Per unit absorption rate 35. The per unit absorption rate take number of units. 1,837,500. 52,500. This is the budgeted activity level. Answer is there in B. The correct answer is B. Don't expect straightforward questions from the examiner. Inventory level වෙනස්කම දෙනවා, marginal profit එක දෙනවා, ඒකෙන් absorption rate එකක් දෙනවා, absorption profit එක හදන්න. No. This kind of logical questions also examiner can be tested. Nice question, I would say. Right? Smart student can only answer this question. It's required some sort of mathematical knowledge also, right? Otherwise, you might not be able to figure out the answer in this way, right? Fine. I didn't use any new equation here. I use only this equation, right? Fine. Question number 7. A company had opening inventory 48,500 and closing inventory 45,500 units. Profit based on marginal costing were 315,250 and on absorption costing it was 288,250. What is the fixed overhead absorption rate per unit? Fixed production overhead absorption rate per unit. Right? Absorption rate they are asking. Opening inventory 48,500, closing inventory 45,500. Change in inventory level. How much? 48,500 Closing inventory 45,000. 45,500. How much? $48,000, $3,000, right? Then profit marginal costing 15,315,250. $288,250. $27,000, right? They are asking what? Absorption rate. Absorption rate. සමීකරණය ගන්න මේ පැත්තට. Absorption rate කියන්නේ difference in profit divide by මේ පැත්ත absorption rate විතරක් තියනවා. Change in inventory level you have to take to other side. එහෙනම් divide by that. 9, right? 9 per unit. The correct answer is what then? D. Correct answer is D. Question number 8. Which of the following are acceptable basis for absorption production overhead? Which of the following are acceptable basis for absorption production overheads? Right? Direct labor hours to absorb fixed production overhead. Machine hours, yes, that is also fine. As a percentage of prime cost, that also fine. Per unit. අපෙන් අහන්නේ which of the following acceptable basis for absorption cost in overhead? overhead absorb කරන්න මොකක්ද හොඳ basis cost drivers ටික? Direct labor okay. Machine hours also fine. As a percentage of prime cost also fine. Per unit also fine. So the correct answer is what then? Method 1, 2, 3, 4. All methods are fine. Right? So the correct answer is what then? C. Correct answer is C. Question number 9. Read and try. So it says, absorption costing is concerned with which of the following? Direct material, direct labor, fixed cost, variable and fixed cost. Absorption costing concerned with no direct material? No. Direct labor they do not want. Fixed cost might not itself enough. Variable and fixed cost. Yes, correct answer is what? Variable and fixed cost. Because in absorption costing is when absorption costing is concerned with including the total cost of production product and appropriate share of overhead, right? Or indirect cost in other words, right? Overhead can be fixed or variable, right? Therefore, option D if you look at is the correct option. But in option 1 and option B are incorrect because they are relates to direct cost, right? And option C incorrect because it does not take into account what? Variable overhead cost, right? Variable overhead cost they will not consider. Then question number 10, right? Question number 10. A company has established a marginal cost in profit 72,300. opening inventory was 300 units and closing inventory 750. The fixed production overhead absorption rate has been calculated $5 per unit. What is the profit under absorption costing? Simple. You can do faster than me since we have done many questions on the same topic. Right? Difference in profit you have to calculate. Difference in profit, how do you calculate? Right? Change in inventory level 750 minus 300, 750 minus 300 into absorption rate per unit 5. What is the correct answer? $2,250, right? Difference in profit. Now they have given us marginal cost and profit. Profit, marginal costing 72,300. Now how do we adjust difference in profit? Activity level, what has happened? Opening inventory to closing inventory has been increased, therefore absorption cost in profit should have been increased, therefore you have to plus this 2,250 plus 72,300, 74,550, 74,550, 74,550 reflect in answer C. The correct answer is what then? C. Question number 11. A company produces and sells a single product whose variable cost per unit is 6 per unit. Fixed costs have been absorbed over the normal level of activity 200,000 units and have been calculated as 2 per unit absorption rate they have given. Current selling price is 10 per unit. How much profit made under marginal costing if the company sells 250 units, right? 250 units. Contribution how much? Contribution. Selling price 6 per unit, sorry 10, variable cost per unit how much? They have given 6, contribution per unit 4. They are asking profit made under marginal costing. When you calculate profit under marginal costing, you have to figure out what? Contribution first, right? This is per unit contribution. Total contribution how much? 4 into how many units they have sold? 250,000. Right? 250,000 units they are going to sell. Right? If company sells this much of units, 1 million. Then deduct fixed cost. How much the total fixed cost? The fixed cost have been absorbed over normal activity level 200,000 per unit absorption rate 2. Irrespective of the unit sold, you have to consider fixed cost as periodic cost in marginal costing. At activity level 200,000 per unit 2, total fixed cost how much? 400,000. Profit 600,000. Profit how much then? 600,000. The correct answer is what? Correct answer is B. Simple. Question number 12. Read question number 12 and try it. Again, same type of logic you can use to figure out the answer. Right? A company which uses marginal costing has a profit of 37,500 for a period. Opening inventory was 100 units and closing inventory was 350. Fixed production overhead absorption rate 4 per unit. What is the profit and absorption costing? Simple. You can do even faster than me. Change in inventory how much? Closing inventory to opening inventory 100 to 300. Opening inventory 100, closing inventory 350, absorption rate they have given 4, change in profit how much? $1,000. Change in profit this much. They have given profit under marginal costing. Profit marginal costing how much? 37,500. Since activity level has been increased, absorption costing profit should be increased 30 by 1000. The answer is what then? 38,500. This is the third or fourth question in the same format. Correct answer is what then? C. Right? Question number 13. A company manufactures and sells a single product. For this month, the budgeted fixed production cost, fixed production overhead are 48,000. Budgeted fixed production overhead 48,000. Budgeted production is 12,000 units and budgeted sales are 11,720 units. Budgeted production they have given, budgeted sales they have given. A company currently uses absorption costing. If company uses marginal costing principle instead of absorption costing for this month, what would be the effect on the budgeted profit? Right? First, calculate fixed production overhead absorption rate for this. We need to calculate that first. Fixed production absorption overhead absorption rate. How do you calculate? Total fixed production cost 48,000. What is the activity level? For that, budgeted production 12,000. 48,000 divided by 12, 4 unit. This is the absorption rate per unit. Fixed production overhead absorption rate. Now we have to figure out increase in activity level how much? Activity level has been increased from 12,000 to budgeted production 12,000, budgeted sales 11,720. Change in activity level. 12,000 budgeted sales 11,720. Change, this is the change in activity level. $280. So then you can calculate change in profit. Same concept. 280 into 4. 11,120 profit difference. They are asking if the company use marginal costing system instead of absorption costing, what would be the impact? Activity level has been reduced, right? When activity level reduced, change in profit according to absorption costing it should be reduced. Therefore, the correct answer is what? 1120 lower, right? 1120 lower is the correct answer. Question number 14. A company operates a standard marginal costing system. Last month its actual fixed overhead expenditure was 10% above the budget results. In fixed production, fixed overhead expenditure variance of 36,000. What was the actual expenditure on fixed overhead last month? Nice question. Right? Same logic you have to use in a different, you have to see from different angles, right? Don't expect straightforward questions, right? Fine. According to the given information, if budgeted fixed production overhead 100, let's say if fixed overhead, let's say 100, right? 100, එයාලා කියනවා last month actual fixed production overhead කරන 10% more, right? Actual fixed production %10 more, which means 110%. 110, right? 110. Because of the variance, emanisa variance, how much? 10%. 10%, right? 10% is the variance. If right, then there are fixed expenditure variance. Budget if the fixed production variance 36,000. If fixed overhead expenditure variance 36,000. Variance 36,000, right, which means 10% of budget. Budget, no? 10% of budget. අපෙන් අහන්නේ මොකද්ද? Budgeted fixed production overhead expenditure. Now variance is this much. Therefore, if you take 36,000 divided by 1%, 10%, $360,000. 360,000. 60,000. The question is what? What is the actual expenditure on fixed overhead? So this is the equation. From that you can calculate this. Actual should be what? 360,000. If variance, now apply numbers. If budget the variance is this my actual budget එකට වඩා actual එක 10% වැඩි වෙනවලු. Right? මෙන්න වැඩි වෙච්ච ගාන. Variance is this much, no? So then budget එක කීයද එනවා? 36,000. 360,000 minus 36,000. 324,000 budget. Right? Sorry, you don't need to calculate this, but answer is this. End up with this. For us to calculate balance part, it needs some detail. But anyway, actual you can calculate in this way. Question number 15. Last month, when a company had an opening inventory of 16,500 and closing inventory of 18,000 units, the profit using absorption cost in 40,000, the fixed production overhead rate absorption at 10%, what would be the profit for the month using marginal costing? Simple. Right? Increase in activity level how much? Opening 16,500, closing inventory 18,000, this has been increased, which means absorption profit should be higher, right? Absorption rate 10%. What's the change in profit? $15,000. Now, what they have given us, profit using marginal costing system how much? So, absorption costing 40,000. Profit, they are asking marginal costing, absorption costing 40,000. 40,000. Since inventory has reduced, marginal costing right? How much? 15,000. Because if closing balance increase, inventory activity level increase, absorption profit should be higher. Since absorption cost in 40,000, absorption profit cost in profit 40,000, marginal costing should be, profit under marginal costing should be 25,000. Right? There are two more questions. Yeah. Question number 16. Last month a manufacturing company profit was $2,000 calculated using absorption costing principles. They have calculated this based on absorption costing principles. If marginal costing principles has been used, a loss of 3,000 would have been occurred, right? The company's fixed overhead cost, fixed production cost is $2 per unit. Sales last month were 10,000 units. What is the last month production? Right? Any change between, understand, any change between marginal and absorption costing is due to what? Change in activity level that we have discussed. Any change in marginal profit and absorption profit due to activity level change. If activity level does not change, definitely there is no difference between marginal costing profit and the absorption costing profit, right? Now, they have given absorption costing profit. Profit they have given $2,000, and marginal costing 3,000. $1,000 is the difference. Marginal costing එක profit එක වැඩි, which means activity level should have been reduced. right? If activity level increased, absorption profit should have been increased. The company change in activity level. The company's fixed production overhead cost per unit 2 and the sales last month 10,000. Sorry, this is loss. They have given it as a loss. Here, loss of 3,000, which means the change, sorry, 5,000. Absorption costing profit is higher compared to marginal costing, right? The difference is 5,000. Change in activity level then 5,000 divided by absorption rate. Apply this formula, right? Change in profit, this is a change in profit 5,000. Level of activity change we want, we have absorption rate. Since we have this 5,000, take fixed production absorption rate to this side, so then change in activity level will come, which means 5,000 divided by 2,000. When you divide 5,000 by 2,000, 2,500 units, right? What is the last month production? How do you calculate production? You have sold how much? 10,000. 10,000 you have sold. Now what has happened? Marginal costing profit should have been reduced, which means closing balance should have been increased. Absorption costing profit increase means closing balance activity has been increased, plus 2,500, 12,500. Because marginal costing profit එකට වඩා absorption costing profit එක වැඩි වෙලා තියෙන්නේ $2,000. ඒ කියන්නේ sale production එක මේ අවුරුද්දේ activity level එක වැඩි වෙලායි තියෙන්නේ 12,500. Correct answer is what? D. Correct answer is D. Next question. Right? HMF company produces a single product. The budgeted fixed production overhead for the period are 500,000. Fix the budget output for the period 2,500. Opening inventory at the start of the period 900 units and the closing inventory at the end of the period 3,000 units. If the absorption rate costing principles were applied, profit for the period compared to marginal costing profit would be which of the following? Change in inventory how much? Same formula, right? Nothing new here. Details in a different way examiner can put, right? Change in activity in inventory level 900 to 300. Opening inventory at the starting period 900, 300. Absorption rate, how do you calculate? They have given total fixed production overhead cost. Instead of giving straight away absorption rate, we have to figure out it. Divide by 2,500. $600 into 200. 120,000. 120,000. Now activity level has been reduced, which means absorption profit according to absorption costing should have been reduced. The question is profit for the period compared to marginal costing would be which of the following? Which means it should be lower 120,000. Why? Because activity level has been reduced. The correct answer is what then? D. So, those are the questions that examiner can be tested from this topic, marginal costing versus absorption costing. I think we have done fair set of questions which will help you to manage any exam questions. Different set logics examiner can use to set up questions from absorption and marginal costing. Fundamentals we have did, questions also we have discussed. That is more than enough to handle exam questions. Thank you.